Atocha Global Analytics. Please like and subscribe. Greetings, salutations, and howdy to you all. I'm KT with Atocha Global Analytics. As always, I wish to remind you that Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. So welcome back to Forecast Friday. This is our weekly segment, and this is Friday, the July 4th, 2023 edition. So let's roll. This week had a handful of updates to our data tables. Next week will be stronger, but we need to address a couple matters and individual line items in a bit more depth. So here we go with something noteworthy to start with. First, and you know, it's something that really is of concern that came up this week, but we have to reinforce what is common knowledge here at Atocha Global. You know, government policy, whether that's the Federal Reserve, though technically that's not the government, it's, you know, but it's semantics, or the federal government itself. Think fiscal, monetary, and regulatory policies. These are really the most impactful influences on the U.S. economy, other than, say, energy costs, which actually is also heavily influenced by governmental policies. But these policies can influence supply and demand, raise or lower business costs, raise or lower commodity costs. And so we have to use some keen insight into how these might be impacting us. Well, these governmental forces are creating stresses in the economy, and we need to highlight something the Federal Reserve's interest rate policies have been causing. And we see data right now reflecting an increasingly adverse impact of these higher interest rates. So the Federal Reserve has two lending windows or lending facilities that banks use when needed for matters of stress. One is actually quite new. But anyway, they typically consider these resources, you know, lenders and the stock market, et cetera. They consider these resources as, you know, kind of the last resort. As even making use of them really can make it can create a stigma, I guess you could say. So when they use these facilities and that increases, you know, this is a flag of banking stress. If, you know, if it is just one bank using it too much, like Silicon Valley Bank, for example, then use of a facility could cause depositors to flee. What if it's the broader swath of banks? You know, if it's a lot more banks. Well, if use of these facilities increases in a noteworthy way, you know, that's really of concern. So you have to pay attention to that. And so as part of Forecast Friday, we were doing just that. We have two facilities, again, to highlight, and they're reported by FRED, you know, which is the Federal Reserve Economic Data System. And these reflect a recent increase in both these lending facilities, actually a significant increase in banks borrowing from them, as a matter of fact. They are known as the Federal Home Loan Bank and the newly established Bank Term Funding Program. So those are two facilities. You know, a noteworthy increase in either or both of them really is concern for a renewed banking system crisis, you know, because it's expanding from the initial salvo we had in the spring with Silicon Valley and such. So first, let's feature the Federal Home Loan Bank, that facility. And as you can see here, you know, that's at about a 1 trillion plus level right now. And it's actually a tad higher than at the height of the financial crisis. So that is really of note. Yes, it's higher, but of course our money is worth less now. The economy and banking system is much larger. So that may not reflect a higher stress level than, say, 2008, 2009. But also, this is now one of two facilities we have now, and we're currently being told that everything's fine, you know. But those windows are being used regularly now. And the second one, though it's only months old, is being used as well. So here's that second one, the Bank Term Funding Program. So we're about 100 billion for 4 straight weeks on that one, which is right at the highs for that. So just to frame this, what kind of numbers are really normal for this? So before I convey what normal is, please take a moment to like and subscribe. Well, before 2020 is the best time frame to gauge normal because the economic shocks from the lockdowns and reopenings really snafu'd the baseline. But the average in the 2016 through 2019 time frame varied between 600 billion and 750 billion. It is also around, 600 billion or so from 2005 through 2007, which was before the financial crisis. And, back then it began increasing as stress built in the financial crisis and Great Recession. Looking at today, that 600 billion to 750 billion baseline seems pretty reasonable. So between the two facilities right now, we are at 1.143 trillion for the first quarter of 2023. We don't have the second quarter yet. They haven't updated the Federal Home Loan Bank for the second quarter, so I can't get that. But the insiders have quietly noted that the trajectory is still reflecting that rapid increase seen through Q1. So while the Bank Term Funding Program is reportedly weekly, it has stayed at the 100 billion level for the last 4 weeks. So we're going to keep monitoring this. We'll carry this forward in successive weeks because this area has potential to create a systemic collapse, much in the way as what we saw in 2008, 2009. And now let's go on to the second highlighted item. So we monitor not only our own PMI numbers here in the U.S., but some other dominant economies because the U.S. economy could be tripped up if somebody else's economy falls down. So China is of concern right now, and of course the Eurozone as well. But however, after China's PMI, it's been under 50 for 8 straight months. So meaning it's in contraction territory, above 50 being expansion, below 50 being contraction. And it seems to have gotten stuck at the same basic level. And, of course, we watch the general PMI for the U.S. and various other places for our clients and for our channel updates. We also unpack some other subcategories buried in the data and look for noteworthy trends that should be highlighted for our regular clients. So anyway, again, similarly for China, the Eurozone, and a few others, we focus on that. And so here's some targeted categories for China, just to put it in context. The PMI for manufacturing in June was 49.0, which moved up ever so slightly from 48.8. Now, remember, manufacturing is a key sector of the Chinese economy because so much of their country's GDP is derived from manufacturing and exports, etc. So the subcategory associated with new orders was 48.6. Again, still contractionary. The subcategory associated with exports declined to 46.4, which is a 5-month low. So they are just kind of dragging along the bottom right now as that looks. The PMI subcategory associated with the service sector was generally positive, 53.2. In June, but it's down a little bit from 54.5 in May. And just to note, this is well short of economists' expectations for the month. So it looks like there may be additional stress is building. Oddly, the subcategory associated with construction was at 55.7, which is a huge contributor to Chinese GDP. But even though it still seems to signal expansion, it has declined, and it seems to be kind of a hollow measure when they're constructing buildings and demolishing them at the same time. That's something that's been covered on the channel and in the news regularly. So I guess they're building faster than they can knock them down. But anyway, so a few more items from this. Subcategory associated with overall employment in China measured the following. It was down about 48.2, and that's part of a 4-month slide. The service sector employment similarly slid for 4 months to 46.8. The previous month, the overall PMI measure that combines good and services slid from 53.2 from 53.9. So, the trend really is not their friend here. Lastly, just an intriguing stat here, their youth unemployment, it's age 24 and below as they measure it. It's over 20%. So they're really struggling over there in China, and we'll see what happens as a result. The government in the Republic of China, they've kept their economy buoyant for a few decades now through a lot of their internal policies, and the public response to these stresses kind of getting out of control, that's tough to predict. So we'll keep an eye on it. And as we shift to our weekly forecast metrics, please take a moment to like, subscribe, and hit that notification bell. We'd appreciate that. Um, by the way, before I go into all the individual line items, I wanted to let you know that there's a unique tool called the Manheim Used Vehicle Value Index that we can use to measure, that market, how it impacts inflation, et cetera. And we don't typically cover it on the channel, but that has shifted down quite a bit recently. And there's a lot of predictions that used car prices will be dropping significantly soon. So this may be true or not, but we added it to the list to track it. Regardless of where it is headed, this index may it's still way above its historical average, so it may or may not be legitimately a problem right now. And it's skyrocketed in 2020, and it's yet to really normalize after that. So some declines might be warranted right now, but too much too fast can be a real sign of economic weakness. So we'll get to that at the end of the list. But so let's look at the metrics we cover every week and see what shifted. We have a handful of metrics that have been updated, and here we go. Of course, the Baltic Exchange Dry Index, again, still a mixed bag, but it is still moving down on a weekly basis. That quarterly number is holding up, but overall, it's way down. That monthly rail traffic data still hasn't come through, but we expect it soon. Of course, the China Containerized Freight Index, we track that. Look at all that red, both quarterly and weekly. It's down. So imports to the U.S. are down, and from China and around the world. It is really down. The FreightWaves National Trucking, the truckload index, it's flat, but as you can see, it's still down. They are starting to see some seasonality there, so things are potentially stabilizing and improving. And the 10-year spread, it's actually looking better. It's improving, but at minus 0.89, that spread is still historically broad. So an improvement off of the worst ever is still in bad territory. So don't let the green lie to you there. And moving on to the second table, retail occupancy and the retail rental rate. Both of those have improved a little bit on a quarterly basis. And as far as the retail sector, it looks like people are holding their own, and we aren't seeing an appreciable increase in vacancies. The cardboard box index continues to fall. That means a lot of our items that are shipped aren't being shipped because they don't need boxes to ship them. So whether it's because they are burning through inventory and aren't ordering as much, or a general slowdown in the economy, that hasn't proved out yet, but it is noteworthy. The average weekly hours moved up slightly, while weekly claims moved up as well. So it's obvious that the unemployment situation is starting to show more stresses right now. Manufacturers' new orders, we had a really good bump on consumer goods, but non-defense slid a little bit. So it's kind of a mixed bag. Mortgage delinquency rate and more foreclosure starts. That data is actually coming out as I'm putting out the video, so I'm not able to update that, but we'll have it for you next week. Consumer confidence index, definitely improving. So what we had seen early in the year is being burned off. That doesn't mean that we're in a fabulous position, but it is looking better. Moving on to the third table, money supply has improved slightly in the last month, but overall it's still a bit of a concern. The change in manufacturers orders for durables, it's almost flat. I expanded it so you could see that there's a slight negative there, but it is still generally about the same as the previous month, and so we're down a little bit quarterly. And then, of course, shooting down towards the bottom here, I wanted to highlight this week the Manheim Used Vehicle Value Index. It's down monthly and annually. It's moving fairly quickly, but we'll see how it trends in the coming months. So Anyway, that was this Forecast Friday's metrics, and it moved pretty quickly because of a limited number of updates. There are a lot scheduled next week, so next Friday should be a little bit more focused on these different metrics moving. As always, if you believe something is worthy of being on this list, please suggest it in the comments. Thank you for joining us, and I will catch you next week. Atocha Global Analytics was created to provide insight and foresight into the street-level impacts of macroeconomics, real estate and finance trends, and the policies that shape them. What is happening in the financial world today shows us that those of us on Main Street are in a street fight for our financial futures. In order to win this fight, we need to become truly streetwise.